$12 trillion. That's how much private equity is projected to manage by 2029. It's a staggering number, but the real story is what's behind it. Firms expanding into infrastructure, secondaries, private credit, and redefining how they build teams, structure the deals, and create value. If you work in or around private equity, this is a moment to pay attention. Explore our private equity content hub for insights, research, and tools to keep you sharp. Visit cfainstitute.org/PE to browse the collection.
Looking to boost your financial modeling skills? The Advanced Financial Modeler Accreditation is designed to help you strengthen and validate your financial modeling skills. In the AFM program, you will become an expert at building a world-class three-statement financial model of a company from scratch. Learn more by visiting fminstitute.com today.
Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking with Bob Elliott, who is CEO and CIO of Unlimited Funds. This company creates low-cost alternative style funds, and we're going to talk to him a little bit more about that in a second. Previously, he was with CircleUp, Alevant, and he headed Ray Dalio's team Bridgewater Associates, which I'm sure you've all heard of. Bob got his BA from Harvard. So, Bob, thank you for being here.
Thank you so much for having me.
Well, could you start off with telling us a little bit about what the goal of Unlimited is?
Yeah, I've spent most of my career in the 2 and 20 business, and I'm sure your listeners basically know sort of 2 and 20 meaning a wide variety of different alternative strategies, whether it's venture or hedge funds or private equity, et cetera. And over the course of my career, sort of increasingly recognized that 2 and 20 businesses are pretty good for the managers and not that great for the investors. And the reason why that is a couple reasons. One is the fees are too high. Two, the products are illiquid. And three, particularly for taxable investors, those products are very tax disadvantaged in terms of how they're normally accessed. And so that got me to start to think about whether there was a way to start to bring the concepts of diversified low-cost indexing, which obviously has totally changed stock and bond investing, and bring that to the world of 2 and 20. And so one of the challenges there is there's many people working on sort of access to alternatives, but most of those strategies are increasing the fee problem.
Right. They're adding another layer of one on top of that. Yeah.
Exactly. Rather than, the great work that the vanguards have done, which is more access at lower fees, right? And so our thought was, instead of trying to invest directly in the products, use our decades of experience having built these 2 and 20 strategies and build technology that replicates how those managers are positioned at any point in time. And then because we can use that technology and translate it into long and short positions in low cost, index securities like futures and ETFs, we can then build products that are broadly accessible, more liquid. And because we're using technology instead of, paying star PMs, we can also charge a lot less than typical 2 and 20 strategy.
Right. This is one of the things I thought was very exceptionally interesting to speak with you about, is how you're doing that. But before we get there, I just want to tell people that they can go on to your website and see a lot of the sort of nuts and bolts about how you've lowered risk and raised the returns through, through some very, very comparatively cheap products through an approach like that. So let's get to it, because there are a lot of portfolio managers and analysts here who've heard a lot about AI. Maybe they've played around with ChatGPT and some other things, but have no idea how to handle it in their day-to-day basis. So what do you do with it?
Yeah, we are using machine learning, and I like to say we were doing AI before it was cool, in our process. And really, I mean, having built systematic investment processes for a couple of decades, AI, machine learning, these are just new tools. These are more tools at our disposal to help build more rigorous analysis than maybe we were able to do 10 or 20 years ago. But at the core, any sort of investment product or investment understanding starts with an understanding, a core intuition or understanding, and then uses the tools to reflect that understanding rather than the other way around. And I think the main reason why that is because, if you're trying to categorize pictures of monkeys, let's say, or cats or dogs or whatever, you can have essentially an unlimited sample size of data to be able to do that. And that's where, sort of very traditional AI type work is highly effective. When you start talking about financial markets, unless you're trading tick data, which 99.9% of people are not trading, there just simply isn't the sample size to just apply the AI and let it go. And so instead, what you want to do is you want to pick the right tool for the problem you're trying to solve. Now, for us, what we're trying to do is build a probabilistic portfolio that best replicates how hedge fund managers are positioned, informed by seeing their returns as in comparison to how markets had moved during the same time period. That's a sort of problem where traditionally you'd maybe use long moving average regressions, which have limitations because they have a long back history. You might use a Monte Carlo simulation, but that's got some limitations in terms of its effectiveness. And so machine learning is just the next step in terms of that approach to trying to understand the probabilistic portfolios that these managers are exposed to at any point in time.
Right. So, and if I understood this correctly, what you're trying to do is leverage those things to say, based on where an asset manager's returns and risk were over the last 17 years, whatever time frame we're working at, this is where they're likely going.
Yeah, and in many ways, what we're doing is to start with that sort of basic intuition idea. I'm sure all of us have looked at a manager's returns for a period of time, understood what happened in the financial markets, kind of knew what they were doing, and said, oh, well, they must be overweight tech or underweight bonds or overweight gold, right? That sort of basic intuition, all we're doing is taking that intuition and applying it in a more rigorous and more systematic way than kind of eyeballing it. And I think one of the things that's really compelling about sort of this new approach to replication is recognizing that because positioning is continuous, it also means it's path dependent. So there's actually a lot of information value in terms of what is the highest probability portfolio today that those managers are exposed to in the context of all the data that's available in terms of their path of performance. Because today's portfolio is generating today's returns, but yesterday's portfolio has to generate yesterday's returns, and today's portfolio and yesterday's portfolio have to look somewhat similar to each other because, positions don't flip instantaneously.
Right. That is, we're going to just record this so everyone can hear. That's probably the best and most down-to-earth approach to explaining path dependency I've ever heard. So that's why you come to this podcast, for clarity. So one of the things that, one of the assets, let's get, sort of take it down to that level for a second, that you all have done a lot of research on is gold. And gold is pretty volatile. So how have you been using it in portfolios? Where and why is it such an important factor?
Yeah,
what you've been doing?
Gold is one of the many assets that, for instance, hedge funds trade, and so in that context, it's one of the inputs into our replication approach. The reality is, I have essentially a personal pet project around bringing the conversation around gold as a valuable tool in the portfolio for any allocator. And the reason why that is because gold serves as a unique asset, different from bonds, different from stocks, different from traditional industrial commodities. It serves as both a contra currency, meaning that it is a non-yield bearing currency relative to fiat currencies, which are yield bearing, but it also serves as a particularly good tail risk hedge, whether you're talking about very high periods of inflation or very low periods of inflation, where fiat currencies have to be devalued in order to re-stimulate the economy. And so when you think about that set of conditions, it's interesting. As a simple example, gold outperforms bonds about half the time that stocks fall. But yet, essentially, everyone holds bonds and essentially no one holds gold. If you were just looking at it on the empirics, you would say you should basically be 50-50 exposed to the two assets over time. But yet there is this view that gold is some Luddite storehold of wealth rather than an important tool in the portfolio.
Yeah, or I thought it was a way to sort of ride the tech boom a little bit because of the consumption of it in the tech process. So let me just back up and make sure I understand that for a second, because it might have been a little hard to translate on a podcast. So the thing you talked about with the relative prices of gold, bonds, and stocks. So when stocks decline, gold rises faster than bonds.
In about 50% of the circumstances.
About half the time. Okay, so what else is happening during those 50% of times?
Right. So there are a couple of different instances where that can occur. One is in an instance where inflation is a primary driver of monetary policy. So as a simple example, what we've seen over the course of the last 5 years,
Right.
I think actually the last 5 years, just generally when you're thinking about whether it's a manager's returns or stress testing your portfolio, the last 5 years have been fantastic because we've basically seen every single macroeconomic environment in 5 years.
Right.
Right. It's why we all got a little less hair and a little more gray up there from trading markets this last 5 years. And so you see in those circumstances, when inflation is driving the picture, often gold will outperform bonds in particular. It also is particularly valuable in periods of very low inflation. So you might have a period where stocks are falling because monetary policy is insufficiently easy, right? You might see bonds rally during that circumstance, but gold often rallies more, particularly when deflation is a risk, because the solution to that problem is the devaluation of cash by the central bank in order to re-stimulate the economy. And so if you go back, for instance, to the 2008 period, gold performed very well during that period as a defensive asset.
Right. But that was probably capital flow, right? That was probably people buying gold as a defensive position that helped to do that, right?
But that's yes and no. There's a fundamental reason why gold would make sense to buy in that deflationary environment. For instance, if you go back to the 30s, gold meaningfully outperformed other assets because the way in which central banks had to deal with that deflationary pressure was by devaluing their currencies. And when I say their currencies, I also mean devaluing bonds, because all bonds are our future currency, right? Relative to hard assets and gold. And so while those circumstances, they feel very, very unusual, right? If you just look at, the last 100 years, in something like 10 to 15% of cases we've had of periods, rolling 12-month periods, we've had a situation where the constellation of dynamics are that, stocks are falling and gold is outperforming bonds.
Okay, and you're talking about in the U.S. only, or is this
no?
Also
in that
Europe?
case, I'm talking about across the developed world,
Developed world. Okay.
Economies,
Okay.
and we shouldn't forget, gold has been a good asset, particularly relative to bonds, in the last 5 years, let's say, in the U.S. But that has occurred in the context of the dollar rallying during that time frame. If you were sitting in Australia or the UK or Europe, right, gold's outperformance has been even more significant. And so, and the reason why that is because those currencies have fallen relative to the dollar. And so while we in the U.S. constantly think about gold in dollar terms, right, the stress test, the case studies of how gold performs in difficult macroeconomic environments, you should look, outside the United States. So for instance, gold and Chinese yuan has been an incredibly high performing asset and attracting a lot of attention there. And so that's what you want to get out of the mindset of, well, gold is a yielding asset and therefore it has no use in a portfolio, and start to think more comprehensively about the wide range of different plausible environments and recognize that basic fact, which is that gold outperforms bonds 50% of the time that stocks are falling. If you use bonds to diversify your stock portfolio, why aren't you using gold?
I mean, this is fascinating, and it's it's an exceptionally interesting way of thinking about the historical perspective on asset allocation, because 15 times over the last, I was in my rattling that through my brain. But I do want to come back to the main thing that you all are doing here, because your blog, which is, I recommend everyone who's listening to the podcast read, is called "Who is Better: Hedge Fund Allocators and Chart Throwing Monkeys." Now, it's very interesting. Could you please explain what you found in your research?
Well, I think let me start with as an investor, a macro trader. The first lesson that you learn very early on is more likely than not you don't have alpha, right? It's more likely than not that you can't beat the market. And why? Because the market's pretty smart, right? And to persistently beat the market means you have to have very unique skill that is, better than the weighted average of all the insight of all the minds out there trading. And yet, when we start to talk about people trying to pick people who can beat the market, there's a lot of confidence that they can pick people who can beat the market, right? And that incongruous stance with the basic idea. It's very hard to generate alpha. So why would your initial assumption be that you can pick people who can generate alpha more consistently than average? Well, that's right. That's right. And so in this particular conversation, really, there's a couple of different pieces that we've written about this, exploring this concept of whether you can actually pick better managers versus worse managers, particularly in the hedge fund universe. Everyone says, well, I just want the best managers. Okay, well, can you actually pick the best managers? And the by and large answer is no, you cannot pick the best managers. And the reason why that is because there is no strategy outperformance persistence, and there is no manager outperformance persistence. And so if you look back through time in terms of, what are the odds that a manager has a certain number of consecutive years of above median performance, a hedge fund manager, above median performance, whether at the industry level as a whole or within their category, what you see is that those managers that have that persistent outperformance, the probability of that is no better than random. Of course, there are some managers that have outperformance persistence, but the question is not do some have that. The question is the frequency of that higher than if you just randomly chose managers? And the answer is no. So there's a lot of lucky managers out there, but there's essentially very, very few managers who have demonstrated a track record of persistent outperformance over an extended period of time.
Right. So when you are out in the world or out on the internet, and you're talking about this to people, what do you hear when they read this, and what do they come back to you with?
Well, I think it's interesting. It's almost that statement that the dart throwing monkeys are as good at allocating as the thousands of allocators and consultants and the whole industry that spends billions of dollars trying to figure that out.
It's like catnip on FinTwit. Right? It's like
that is an affront and a challenge to an entire way of being. Right? Particularly, it's interesting when I talk to more junior people with less experience, having the scars that are out there, having tried to pick and failed. I'll often get responses that are to the effect of, well, if this is true, then I shouldn't have this job. And the answer is maybe that's right.
Yeah, it could be.
Right?
Yeah.
Maybe that is right, you shouldn't be picking because you can't reliably pick. But as you start to talk to people who have decades of experience, it's amazing to hear, the people with the most experience and the most perspective basically take this idea for granted. They say, yes, of course, that's right. No, they say, look, I can think about portfolio characteristics and I can start to build, portfolios of strategies that are more or less complementary to the rest of my portfolio. But they recognize, it's amazing, how often a person with a lot of experience will very swiftly recognize that point and say, yep, that's right. Absolutely. I've been in the trenches. I've tried to pick. It hasn't really worked. So it's better off thinking about the portfolio construction attributes than thinking about the individual managers themselves.
Yeah, and a lot of investors will also benefit from going back to the why we're doing this in the first place. Because sometimes a lot of the chasing of those very special managers causes some kind of goal drift. And sometimes it helps even sophisticated investors to go back to why are we doing this? and then that makes it a little bit easier to see.
And it doesn't, the other thing that's really important in the hedge fund manager space is there is actually a natural bias for those lucky managers to then charge much higher fees. And if you actually think that those managers that have been lucky are now going to charge higher fees than the median, and they have no persistence in terms of outperformance, you actually want to shy away from those managers that have had outperformance over the past and are charging higher fees. Because odds are you're actually going to pay too much for the alpha that they're likely to generate relative to the median, relative to a basket of hedge fund managers, or even more importantly, the true alpha that you can get is by lowering fees, right? There is no more persistent alpha in this world than being cheap.
Right. Right. It's like, it's hard for me to imagine Jack Bogle saying that, but it's more or less what he was saying.
That's right. That's exactly right.
Well, great. So, this has been an exceptionally interesting thing to think about. I really do recommend that, members of CFA Society New York would probably love to take a look at your website, at your blogs, and learn a little bit more about some of the research you're putting back in there. I know a bunch of the CFA New York members are going to start digging into your numbers. So one of the things they're going to see immediately is most of your research goes back to 1970. I'll let you discuss that online with them. But Bob, thank you for being here on the podcast.
Yeah, thank you so much for having me. It was a lot of fun.
And thanks to those of you who listen to this. As said, go check out Bob's website and Limited Funds. Until next time, I'm Rob Rowan, and this has been Compound Insights.